Welcome to the National Planning Championships. In the current economic market, it is very important to take time to talk to your solicitor about tax planning. The first issue that I'd like to talk to you about is capital acquisitions tax. In other words, CAT. In simple terms, capital acquisitions tax is a tax on benefits. Benefits are defined as including any estate, income or right. When we talk about CAT, i.e. capital acquisitions tax, the emphasis is on what the beneficiary, i.e. the person receiving the benefit, acquires. Tax is calculated and charged on the benefit taken. There are two types of taxes that fall under the umbrella of capital acquisitions tax: gift tax and inheritance tax. To explain further, if you receive a gift, you may have to pay gift tax on it. If you receive an inheritance on death, it may be liable to inheritance tax. Both these taxes are types of capital acquisitions tax. If you receive a gift or inheritance from your spouse, it is important to bear in mind that you are exempt from capital acquisitions tax. The benefit, i.e. again, the gift or the inheritance, is taxed if its value is over a certain limit or threshold. When talking about capital acquisitions tax, it is always important to bear in mind that there are tax-free thresholds that apply, and that this depends on the relationship between the person giving the benefit and the person receiving the benefit. It is worth bearing in mind that there are also a number of exemptions and reliefs that depend on the type of the gift or inheritance received. Next issue is we're going to talk about group thresholds. So what are these group thresholds? Gift and inheritance can be received tax-free up to a certain amount. The tax-free amount or threshold varies depending on your relationship to the person giving the benefit. There are three different categories of groups, so it's always worth bearing in mind what group do I fall into. Let's start with the first one, Group A. This applies where the beneficiary, again the person receiving the benefit, is a child of the person giving it. This includes a stepchild or an adopted child. Group A also applies to parents who take on inheritance from their child, but only where the parent takes full and complete ownership of the inheritance. The next group to consider is Group B, and this applies where the beneficiary is the parent, so we also need to consider Group A here, grandparent, grandchild or great-grandchild, brother or sister, or nephew or niece of the giver. And finally, Group C. This applies to any relationship not included in Group A or B. In other words, where the beneficiary is anybody else. So this will include uncles, aunts, stepbrothers and sisters, grandnephews and nieces, cousins and strangers in blood. And to conclude on the topic of capital acquisitions tax, CAT is charged at 25% in respect of the gift or inheritance made from midnight on the 7th of April 2009. The rate was formerly 22% in 2009 and 20% in 2008. When talking about capital acquisitions tax, everybody always wants to know whether they can apply for any reliefs or exemptions. This is an extremely important tax planning device, and where practical, you should seek to be advised of the most effective way of transferring assets to your intended beneficiaries. To outline the main types of reliefs, the first one I'm going to talk to you about is favourite nephew or niece relief. By way of background information, with the large number of small holdings coupled with the high number of bachelor farmers in Ireland, together with the increasing acreage required in order to generate viable income, necessitated the introduction of favourite nephew or niece relief for gift and inheritance tax purposes. The relief operates on the basis that a nephew or niece who has worked substantially on a full-time basis is deemed to be a child of the uncle or aunt and eligible to receive a tax-free exemption of $542,544. The next relief I'm going to talk to you about is agricultural relief. Tax relief applies to gifts and inheritance of agricultural property and reduces the market value of the property by 90% for the purposes of capital acquisitions tax. In general, the relief applies provided the beneficiary, i.e. the person receiving the gift, qualifies as a farmer. So we now need to consider, well, what is a farmer? For the purposes of the relief, the person receiving the gift or inheritance must be a farmer. Farmer means an individual whose agricultural assets exceed 80% of their total asset base after taking a gift or inheritance. Now we need to ask ourselves, what is agricultural property? Agricultural property means agricultural land, pasture, woodland situated in a member state of the EU. Crops, trees and underwood, houses and other farm buildings appropriate in the property, livestock, bloodstock and farm machinery. And finally, the last relief I want to outline to you is consanguinity relief. This relief applies to transfers of property to certain relatives, including a parent, step-parent, grandparent, child, brother, sister, half-brother, half-sister, aunt, uncle, nephew or niece. The relief does not extend to cousins or in-laws. Stamp duty will be payable at half the normal rate applicable to the transfer. This relief does not apply to leases.